Open your cerebral cortex and shift your lobes into upper beta phase because you are going to have Bitcoin knowledge transmitted directly into your vestibulocochlear. Your host at Bitcoin Knowledge is Trace Mayer, an early Bitcoin advocate since it cost $0.25, but this is not intended to be investment advice. A doctor of jurisprudence, but this is definitely not legal advice. And an investor in core cryptocurrency infrastructure, including Armory, BitPay, Kraken, and Nitagio, but this is not a recommendation of those services. Here, you get fed via direct mind download with pure and free Bitcoin knowledge.
Welcome back to the Bitcoin Knowledge Podcast. We have another returning guest with us, Brock Pierce. Brock, welcome to the podcast.
Trace, great to be back again.
Yeah, so you're a managing partner at Blockchain Capital. You guys just did this VCtoken.com where you raised $10 million, but it's on the blockchain. Like, maybe you could help explain a little bit about like what you've done, why you did it, and what, some of your plans are going forward.
Yeah, well, so what we did is we launched the first ever ICO of a venture fund. The idea being that we would raise money from a broader source of partners. Well, so the first thing we did is we decided to raise $10 million in the form of an ICO, and that happened, and it was very successful. We sold out in the first 6 hours, and it probably would have been a lot faster if we hadn't encountered some technical difficulties. So it was a success. Now the reasons why we did it. For one, historically, the venture capital industry is one that has been kind of solely or exclusively available to call it the financial elite, the pensions, endowments, and big family offices and the likes. So crowdfunding is something that I've followed very closely and been very interested in. I think I run the largest personal syndicate in Southern California on AngelList. My firm runs a syndicate there. We've syndicated, over a dozen deals at this point. And so I'm a big fan of the crowdfunding sort of phenomenon and everything that's been happening in the US around the Jobs Act, because at its core, what it's doing is it's democratizing venture capital, and it's making, it available to a broader group of prospective investors. So in the same way that crowdfunding was the first major leap in the democratization of venture, I think what we just did is the next even larger leap of truly democratizing the world of venture capital. And so, as a VC, we're an industry that has benefited greatly from technology and the internet. But as an industry, we invest in disruption and innovation. But, how have venture capitalists innovated in their own business? They generally don't. So, it's an exciting thing, and I'm an entrepreneur first and foremost. So when I look at these, situations, my view is probably a little different than most VCs or most incumbents. Most incumbents are figuring out how to protect their business, from, innovation and disruption, where, my nature is more lean into it. Someone else will come along and do it if it's a good idea, and they'll disrupt me or my business. So I might as well be the one to do it to myself. My partner, Bart Stevens, was at E-Trade in the 90s, and E-Trade was putting all of the traditional brokerage businesses, putting their backs against the wall. And so Bart was reporting to the CEO, running Corp Dev and Biz Dev. And there was another business at the time called Charles Schwab. Charles Schwab being a traditional brokerage business. And, when confronted with the innovator's dilemma, they made the decision to go compete with E-Trade and cannibalize their entire existing business. And in the process, they built a business that's still successful today, whereas most of the other sort of brokerage businesses were, completely disrupted and disintermediated by low-cost, brokerage providers. So that's one part of why we did it. The other is our first two funds only invested in startups. They did not invest in ICOs, though I've been very active in the ICO market since the beginning. I'm a founding board member of Mastercoin, which was the first ICO, and where the model was kind of architected. And so I've been in the ICO market, all of this time as an individual investor, but not as a fiduciary or as part of my fund. Our second fund was prohibited from investing in tokens, and that's because some of our large LPs already had big Bitcoin positions, and I think they were hoping to, they didn't want us buying Bitcoin and collecting fees on, Bitcoin gains, which was understandable. But that prevented us from participating in some of the things we would have liked to. In our third fund, we are going to be investing in a combination of startups and, in some cases, ICOs. And so, if we're going to be investing in that space, you might as well be practicing what you preach as well. I also have an issue with a lot of the ICOs to date. And again, you have to look at each of them, on a case by case basis because they're all different. They all have different, use cases and what their token uses are, and every single one of them is different. So, I think in a lot of cases, some of them look like securities, and so I think that what people have been doing is they've been going through great lengths to create these very, in some cases, convoluted models for the purposes of circumventing securities law. And, everyone's kind of following what the last person did. So, at Mastercoin, we did this foundation structure and, kind of everyone copied that. Eventually, Ethereum copied that, and Ethereum did it in Switzerland and spent, real money on legal to get the structure right. And everybody just kind of copies that and not necessarily doing the work to validate whether it's appropriate for their business. So instead of trying to circumvent securities law, the question we asked ourselves for the last year and the work that we did was, can this be done in a compliant way, acknowledging that you're a security? And what we determined was that you can. And so I think for a lot of these ICOs, the structure and path that we used might be right for them. And, I would advise, anyone working on an upcoming ICO to look closely at our model and fork it, copy it, use it if it's appropriate for your specific business. And the reason, I want that done is I want to be able to invest in more of these ICOs, and I'd like to invest in ones that are compliant in all cases if possible. We were the first ICO to do KYC. We're the first one to acknowledge we're a security. We did this out of Singapore. We utilized Regulation S and D exemptions within the SEC. We had a real 75-page, offering memorandum, prospectus. I mean, things that you don't, a lot of stuff that no one had ever done before, which is the reason why we limited it to $10 million as well. I mean, there was clearly demand far, far greater than 10 million, but our goal was not to raise as much money as possible. It was to break a bunch of ground and launch this experiment and see how it goes. I think, Ethereum would have been better served if the DAO, had done something similar.
Right. I don't think we need to talk too much about the DAO. Now, when we're looking at the legal structure with this, now these tokens, are they freely transferable? Because that kind of opens up a secondary right. And when we're talking about ICO, this is initial coin offering. So like we're talking about a token that represents like an ownership interest or what traditionally would be shares, right, in the fund.
Yeah, that's essentially what it is. So in Singapore, Singapore and Switzerland are the two jurisdictions that have offered guidance on the issuance of like virtual currencies, tokens, digital currencies, and such. Singapore in 2014, the MAS gave guidance that it's not a security. So the entity that issued the token is Singaporean, and under Singaporean law and guidance, it's not a security, but knowing that the US might perceive it differently, we utilized Regulation S and D, S for the international investors and D for the domestic investors, treating ourselves as if we are a security. So that's a little interesting that you have those two sort of things working differently. But the secondary market. So U.S. investors, one of the things that we have to do to be compliant is KYC every investor, and I think that that's probably something that every ICO should be doing. Historically, people are like, "Wow, if you KYC, then no one's going to want to invest." I said I don't agree with that. I said that theoretically, maybe if you were going to have 10 million of demand, maybe it becomes 9 million. Maybe 10% of your prospective, investor base doesn't want to invest because of the KYC. I said I'm skeptical, and I said I'd even go so far as to make the argument that I think that by doing KYC, you're going to raise more money. Maybe not for the first couple of people like I've just done, because it's something new that some people might not want to do. But what happens is financial markets don't like uncertainty. And by making the market more compliant, you're going to increase the overall demand, and you're going to bring in investors that might not invest in the space otherwise. So I think that the net result is going to be that by doing KYC, there will be more money available to ICOs over time. Maybe not with the first few, but that clearly wasn't the problem for us. We had more than enough demand. Anyone that didn't like the fact that we did KYC, it didn't prevent us from being successful. So I think that that's probably going to be true of many others. And I would advise, I think, every ICO, no matter what your structure is at this point, to probably be doing KYC. because you can avoid the highest risk elements in doing that. In a lot of cases, you probably don't want to take any money from the U.S. just because that's where most of your liability, stems from. And if you do KYC, you can block all U.S. investors, and that's probably, if I were going to give blanket advice to everyone, I'd block every American. I didn't do that because I want to show people there are still things that you can do to allow U.S. participation. But in our case, we could only work with accredited U.S. investors, and we were limited to 99. And those U.S. investors have a 1-year lockup, and those are, a variety of rules that we have to operate within to be compliant. Now, yeah, these tokens will trade in the secondary market, which is one of the other big problems with venture capital. Venture capital as an asset class has delivered great returns historically, but people don't want their money locked up for 5 to 10 years. And so by allowing that, call it interest in the fund, that share in this case in a closed-end fund, to trade freely, in secondary markets, you now have brought liquidity to what has historically been an illiquid asset class. And I think that that's a pretty compelling thing that I think will probably end up being the model that all venture funds will take at some point in the future. And I think private equity funds, real estate REIT type vehicles, anything where there's a general lack of liquidity, markets love liquidity. And when given an option to take a liquid product versus an illiquid product under the same terms, I think people will take the liquid product every day of the week. And so I think that that's an interesting, thing as well. But, this is an experiment. We're the first in the world to do this. So we'll see how it goes over the next few months. And if all goes well, it's very possible that I won't have a fund 5. And it's very possible that in, 6, 12, 18 months, we may do this again. And that vehicle will become the future of everything my firm does. And we would no longer even have a traditional GP or LP structure at all.
Very interesting. Just kind of from the technical standpoint, you do this KYC. So when the investors get their token, how does the secondary actually work? Like, are those transfers like investor A to investor B of the tokens, like it has to go to another KYC'd investor who's already been approved by the fund, but like the actual transfer doesn't necessarily have to be approved? I mean, maybe you could go a little bit into that.
Well, it's an ERC20 token. So, it's designed to work within, the Ethereum sort of ecosystem, and Ethereum wallets and exchanges, and be pretty easy to plug in. But no, it should trade on crypto exchanges.
Oh, wow. So you'll be able to, so people can become investors without having gone through the initial KYC.
The BCAP token should be able to trade on Kraken, for example.
Wow. So then somebody could end up being a holder of the BCAP token without having Blockchain Capital have done the KYC on them?
Yeah. So the way that it works is around the issuance and then ultimately the redemption. We are at the time of issue, just like with a company, we're responsible for whoever receives it. Now, if you were someone in Europe, for example, and you had invested in our fund, and you wanted to go sell that position, that fund, to someone else, that's been being done, in secondary markets long before there was crypto. By using this type of technology, it makes it really efficient and easy. And then there's going to be marketplaces that, allow you to very easily connect, buyers with sellers. And so you should end up with a fairly liquid market, and, we'll be publishing our NAV every quarter, and we'll see how it trades against the NAV, under the scenario where we have a larger pool of capital that is part of a traditional fund structure. It probably won't trade at much of a discount to NAV, because if it did, I'll just buy all the tokens, right?
Yeah.
So much of the same with public companies. We look a lot like a closed-end fund, a public sort of company, where if the company has a ton of cash on its balance sheet and the stock looks cheap, it may buy back shares, right? And if it trades at a huge premium and we get comfortable with the structure, this is when we might, create the next one. But I think we want to see how this all goes first, and we're going to spend some time. The goal here was not to go big, but to learn.
Yeah, break some initial ground. So I'm still
and show people, there are other ways to do things. I really, I've got concerns for a lot of these ICOs. Regulators don't say, oh, you just raised $10 million and you have someone knocking on your door. It's when your ICO and project fails and you lose $10 million and your coin goes down to nothing or something very low, and you have a bunch of disgruntled investors, some of whom may have been non-accredited U.S. investors that were advertised through and broken general solicitation laws and all sorts of stuff. They come after you when your business fails 2 years from now. And that's the issue that a lot of these ICOs have, is they've got regulatory overhang. And I'm not sure investors are adequately assessing that risk.
Right.
Because if founders get into that kind of trouble, that's probably going to have a negative impact on the project as well. I mean, as a VC, I don't invest in ideas. I mean, to a degree, there may be some degree. To some degree we do, but we invest in people. We're investing in entrepreneurs first and foremost. I mean, that's the big bet that we make every time. As we say, this team, are they capable of executing on this good idea? But it's the team first every single time. And if the team encounters major problems, that's normally going to have a big problem. It's going to create a big problem for a project.
Yeah, I actually interviewed Bart, and we went thoroughly in depth into like what you guys and VCs in general are looking for, like in a team to invest. So anybody listening, like trying to raise money, hey, go back and listen to that. I am kind of curious. So we're interacting with the old legal system. Like, where is the actual share registry kept? Like, are these BCAP tokens? Are they proxies for shares, or are you actually innovating where like that's where you're keeping the share registry, or trying to do something like that? Because, using the public company analogy, we've got Seed & Co. And so all the shares are actually titled like in Seed & Co.'s name, but then they can trade like in street name, right? So I'm just kind of curious.
Yes, structurally, it's a little similar to that. So it's a closed-end fund structure out of Singapore that is administered or run by Argon, which is call it the best description of Argon in a traditional financial sense would be, like an investment bank. They would call it the Goldman Sachs of this emerging new sort of crypto world that, manages the book building, the legal, the offering memorandums, things of that nature. And so it's what looks like a closed-end fund structure, and it's administered by the bank that is, in a way providing you a proxy interest, but it's one that's pretty solid. I mean, it's not like most of these tokens where if you read the T's and C's, it says that you as the investor are entitled to nothing, you own nothing, you have no rights. I mean, if you read the T's and C's of a lot of these ICOs, it's like, why are you investing?
Wow.
and that's one of the other big risks with a lot of these as well, is in some cases, these companies that are doing the ICOs also have an actual operating business, right? And they're raising money from people like me for their operating company, and then they're raising money from the public in the form of these tokens or use coins. But in their T's and C's, it says the token holders are entitled to nothing. So what happens if the company gets sold? All the intellectual property normally resides in the corporate entity. They have other investors and a board of directors where they've got fiduciary responsibilities to the actual shareholders, not the token holders. I think what's going to happen here is token holders are going to get left holding a lot of bags as projects fall apart and exits happen, and this failed company that built this really cool decentralized tech and X, Y, and Z might get sold for $20 million, and the team moves on. Project kind of fades away over time, and again, the token holders got nothing.
Well,
because they're entitled in most cases to anything.
We all saw The Social Network, right? Like, and at the end of the day, it's going to be the people who are legitimately on that share registry, who own those shares. Those are the ones who are legally entitled to stuff. And it gets kind of interesting if there's a conflict in fiduciary duty, kind of like you were talking about between.
Well, this is the stuff I've spent a lot of time thinking about when looking at these ICOs, and I mean, I want to throw up a lot of the times. And I get why people are doing it. They're doing it to not run afoul of securities law. And investors are comfortable with this, big leap of faith that they're making so that the company is not violating securities law. But at the end of the day, you still have to care about what your contractual rights are. What are you entitled to? And not be relying solely on the idea that, the founders are going to, make it right when they have no obligation to. You signed up for a deal where you have no rights. And, incentives and things can change over time. And the big thing is that conflict of interest when you have an actual cap table of an actual, incorporated entity, and where you've got fiduciary obligations, where at some point, even if they don't want to, they have to screw the token holder because they have an obligation to a shareholder.
Right. Yeah. So, I mean, and that's really why we have securities laws in the first place, right? Because people have been raising money from other people forever on like hopes and dreams and blue sky. And some of those people have just been running off and stealing the money or otherwise
or changing the terms of the agreement to steal your equity. And these things are all there to protect and in all cases protect sophisticated investors and accredited investors. I mean, this stuff does, have a historical purpose that, in almost all instances was designed with good intention.
Thanks for listening to the Bitcoin Knowledge Podcast. Our awesome audio editor needs to eat. He makes your experience better by increasing the sound quality and decreasing the show's time by editing out unnecessary ums, ahs, pauses, and such. With only a few seconds of your time, you can support the show. Do you ever buy stuff on Amazon? Before you do, simply visit bitcoin.kn/resources. You can get there from the homepage and click on one of the links. It takes you to Amazon. Then, at no additional cost to you, we get a tiny percentage of anything you purchase, even if it's not that particular item. These resources, they're all my favorite hacks that have increased my quality of life, so you might learn something helpful. They range from healthy snacks to sleep optimization, meditation tools, cognitive enhancers, immune system boosters, and much more. Maybe you'll find them useful. Either way, any support is greatly appreciated. Thanks, and now back to the show.
Switching gears. So you guys have gone through the process on Ethereum, written a type of smart contract, I assume. Is this smart contract going, from what I understand, it's going to be able to be just kind of become a template and be used by lots of other people who want to do a similar type of project, right? And that way everybody doesn't have to reinvent the wheel.
Yeah, I mean, that's so, we're not going to directly profit, as in blockchain capital from this, but yeah, I'd like to see, my vision is that you're going to have two types of ICOs. You're going to have these protocol ICOs with, use coins like Ethereum. And then you have other projects where it looks more like you're saying, hey, we're building some cool technology. And essentially the token is kind of meant to be a security. It's like you're an angel investor. And instead of people trying to create uses for a token, just sell them digital stock, right? More along the lines of what we just did. And I think that that's the future. And I think it's going to actually be the death or the end of late stage venture capital or growth equity. I mean, what the blockchain is doing here is it's lowering the bar, for companies to, in essence, go public, right? Normally, a company wouldn't go public until it's very mature because it's very expensive, costly. It requires a lot of work to administer. Sometimes people do these reverse mergers, and you'll see small cap public companies, and those would be probably the best things to look at. But that's a whole, got its own host of issues that, some people are okay with and some people are not. In terms of the management team and investors, it provides for liquidity and often trades at a big premium to what a VC would pay for the same company if it had been private. And I think that that's a liquidity premium that, is actually quite valuable, and hence the reason why a lot of these ICOs trade at the levels that they do. But I think instead of, companies going out and raising a Series C or even a Series B financing, I think you're going to see a lot of non-blockchain companies over the next, call it 5 years. I think the next 1 or 2 years is going to be mostly endemic, sort of industry blockchain-centric stuff, or stuff where on a Venn diagram, there's a lot of overlap of the types of people. So, there's a lot of video game people in crypto. So video game projects may have some potential earlier on, really interesting and advanced technologies, also as well, because, most of the people in crypto are, technology people. So I think that kind of would be next. But I can envision 5 years from now, any Silicon Valley, sort of company that's going out to raise that Series B or Series C will be looking at this as an alternative and say, why would I take money from Andreessen Horowitz, when I can do an ICO and take money from my customers? Again, the same promise that crowdfunding has been being, has provided. And so I think this is going to be extremely disruptive. I think there will still be a role for, people like me, at least for a little while longer, to evaluate call it the pre-seed, seed, maybe even Series A sort of deals in some cases. Like, I don't think we as ICO investors should be funding white papers. I think, we should be demanding more of the entrepreneurs, show me a working prototype, show me a proof of concept, at least have a little something, not just a white paper. Demonstrate that you as a team can work together long enough to actually get a product shipped. And so I think there's probably still a role for, seed financing, which would be a bridge to an ICO. And so I think there'll still be these small 10, 20, 30, maybe even $50 million firms. But I don't think in the future you need these late stage growth, sort of venture funds that are filling the gap between, the startup stage and the public company stage. I think that the blockchain technology is just going to lower the bar to a degree that, companies are going to essentially be going public at a much earlier stage, which I think is going to be good for everybody. Again, liquidity for everyone is a good thing.
So let's dig into that a little bit more in terms of like the actual product or technology that you think we're going to be getting built out because of this. Because when we look at Silicon Valley, like, they're really good at taking something and scaling it, right? Like they take Facebook and scale it. They take Google and scale it. They take Uber and scale it. And Uber's like, I think their last round was like $60 billion valuation, and they're still private, and yet the shares are very locked up. So we get a certain type of product out of that particular type of VC model. You're saying that the VC model is going to change. Well, what types of products do you think we're going to get as a result of that change?
Well, I mean, the same things that we're getting. I think what you're going to see is there'll be more capital available to more entrepreneurs. I mean, that's the thesis of crowdfunding, and why I've been a fan of crowdfunding. By democratizing the space, you're allowing more people to participate in this ecosystem. More people being able to participate means more money being available. More money being available means more entrepreneurs being funded, and with a more distributed sort of investor base. So I think, net, that's a positive thing for, bringing about innovation. So I think, the Uber model of the world could still very well exist in this, vision that I've just painted for you. But instead of it being, 2 or 3 venture firms that, captured the lion's share of the value from that, $100 million to $60 billion increase, when the really late stage sort of sovereign wealth type funds came in, that could all be people like you and me, that had picked them up. I envision the Kraken, sort of exchanges of the future, having 500 startups and protocol tokens running on them. That's essentially what we're seeing on the Poloniex today, right? And the Bitrixes today. The question is, how far, does that market just continue to be, use coins and use tokens, or do they start competing with the New York Stock Exchange and NASDAQ? And I think that that's what's happening is, NASDAQ and the New York Stock Exchange and stock markets around the world are competing to get the new hot companies to launch there. We're lowering the bar because that's what the blockchain sort of technology is doing in this case, to make it more accessible and allow companies to do this earlier. And, I think that those industries will converge over time. And these exchanges that, in our industry are going to end up playing really important roles, in terms of the future of how, things trade beyond just, the digital tokens for the Ethereums and the Bitcoins of the world today. I think you end up with thousands of coins and they look like the securities of, the entire startup ecosystem, not just of our industry, but all industries.
So kind of to wrap up the interview, how is Bitcoin blockchain technology, how's it been doing? How's it going to do over the next year or two?
Well, obviously, 2013, we had a great bull market, which, resulted in us kind of going almost right off a cliff with skid marks. And we had to, fortunately, we're very, this is a very resilient technology, but, we went into a very bear market, certainly for startups. Sometimes you don't see that when you're on the funding side, but, generalist VCs stopped investing in the space. We got a little bit of activity in blockchain, but we were in a very bear market for a few years. A lot of companies, failed to survive, and, some of them, they trimmed down and fought very hard, and, they're benefiting from, this incredible bull market that we're in now. We kicked off this year with, extremely good growth. I think that 2017 is going to be the big year of sort of digital currency. In terms of, user numbers, we're basically where the internet was in 1990. I think from an infrastructure perspective, we're where the internet was in like 1994, 1995. We've got enough of the basic infrastructure in place, the bridges, the roads, the tunnels, the on-ramps, the off-ramps, around the world, that I think that this can be, I think this is going to be the breakout year for digital currency starting to get, adoption. 2013 being a false start. I think this is the first kind of real year where we see meaningful growth, and I think it continues on from here. And then on the blockchain sort of technology side of things, where we, the enabling technology that makes Bitcoin possible being used in traditional industry, I think that this is the breakout year for that as well. We had banks and financial institutions and big Fortune 5,000 companies all over the world experimenting and going through sort of a proof of concept phase. But before you put $1 trillion sort of, industries on top of this technology, you need to test it for a while. And so we've been in a proof of concept phase. And the problem with proof of concepts are they don't pay very well. And so most of these startups have not been generating big revenue. They're not seeing the revenue growth, that get, call it Main Street VCs and Wall Street interested. But I think 2017 is the year that all changes as well. I think this is the year we're moving from proof of concepts to actual pilots, and in some cases commercialized products. Yeah, and when you start to commercialize these technologies, you start to get real revenue, and with that come exits. With that comes a ton of capital coming into the market. I couldn't be more excited about 2017. Obviously, there's still going to be a number of false starts and bad news, and probably more hackings and more scaling debates, and it's not all roses, but I couldn't be happier about the way that this year has started, and I anticipate it continues with some challenges along the way.
Well, I'd add my ratification. I think 2017 is going to be another just excellent year for Bitcoin. It's been wonderful. Thanks so much for taking the time to be with us. We've had Brock Pierce from Blockchain Capital. Thanks, Brock.
Thank you, Trace.
Be sure to get a copy of the free Bitcoin Guide at freebitcoinguide.com. Got a question or suggestion? Record your voice at bitcoin.kn. Don't be shy. To help the show, share bitcoin.kn with friends, post about it on Reddit, and otherwise spam the interwebs. Your iTunes comments and 5-star reviews are very important to us. Please continue tuning in to the Bitcoin Knowledge Podcast, where we release interviews with the top people in the Bitcoin world. Now take some choline and let that Bitcoin knowledge consolidate.